Joining us now, Alexandra Scaggs. She is a reporter for the Financial Times. Alexandra, thanks so much for joining us.
Hi, thanks for having me.
I imagine it's a very busy week for you, and
Yes.
it's like your Christmas in some weird way.
But this is when we really earn our paychecks.
Okay, so let's start. I mean, if it seems to me, and tell me, I imagine I don't have the whole story on this at all, but it seems to me there's like four elements I was saying earlier about this. Yeah. There is the rollback of the 2017, 2018 Dodd-Frank rollback, which changed the threshold in which regulators would check on banks to make sure they're not, undercapitalized, essentially. There is what regulators actually did with those changes in those laws in terms of the way they executed it. There was SBV and maybe and a couple other banks that were doing stuff they shouldn't have been doing. They were undercapitalized, and they could do that because there was no regulation. And then there was depositors depositing more than the FDIC threshold for what would be insured, which is a really weird thing to do for people who have that much money.
Yeah. So, I mean, you've really covered a lot of it.
Let's start at the top and work our way down, I guess.
Regulation. So there are a couple of interesting things at play there. First is, like you said, the stuff you talked about with regulations being rolled back in 2017, 2018. Basically, again, like it sort of raised the size, or it meant that bigger banks could avoid certain kinds of regulations, right? Like it just slightly less oversight, you could say. And
how many banks are there between that? Like it used to be at a 50 billion threshold, and now it's at a 250 billion threshold. Do you have a sense of is there a way to know how many banks are? I mean, surely like okay. So about how many do we have now in that zone?
So I don't have that number off the top of my head, but I can say that Silicon Valley Bank was the 16th biggest bank in the United States by assets. Okay. And it stayed under that threshold, which is incredible, right? Like top 20 bank that still is managing to dodge these regulations. And they were like very, very careful about making sure that they stayed under that threshold too. And I think that's something that's coming out now as well.
Wow. That's like when you go and pull $9,999 out of your bank account because you don't want the IRS to know that you're pulling out $10,000 cash.
Yeah, and they talk a lot about off-balance sheet deposits in their recent like 10Ks and stuff. So like they would say things like, "Oh yeah, well like we have this like several $100 billion in client funds." But they're like not on our balance sheet. And it's like, okay, why are they not on your balance sheet? Some of it could be, okay, our clients want to invest in money market funds now that the Federal Reserve is raising rates. And I think that's part of the story too.
Can you explain that? Because honestly, I've told you everything I understand about finance. You already know what I know. So what does that mean?
Well, like, you did a good job.
It's off their books. But why, if I wanted to invest in a money market, which is like like for a normal person, it just seems like a savings account, gets a little bit higher interest rate. But why would that be off the books? Like, how would they just decide to not include that?
Yeah, it is a little confusing, and they don't give a ton of detail on exactly what that money's in. So like some of it is just standard. You like have some extra cash, you want to sweep it into a brokerage so you can invest it, or so it earns a little bit of a higher return than a checking account, which is usually the returns on those are nothing. And but like, you can have a sweep account that sends things into money market funds, and then they have these other off balance sheet deposits that they don't really give a ton of detail on. And again, like looking at the regulatory thresholds, it just seems like it was a little strange to see that like,
looks like a dodge.
Oh, we could have this money. Maybe, I don't know, like, but yeah. So with all of that, the Federal Reserve, as you all know, has been raising interest rates for 2 years, really aggressively, more or less. And they also had a pretty big bond portfolio of fixed rate mortgages, which like very safe, guaranteed by the US government. The problem is that when interest rates go up, you experience losses on those bonds just because of like math, right? Like prices go down, yields go up. This is something that happens every time the Fed raises rates, but it's been, let's see, a decade since the Fed has actually raised rates in any sort of like aggressive or sustained way. And so no one was expecting their bond portfolio to see losses that were that large.
Okay, and let me just see if I understand this. If I have a bond or a loan essentially at 2%, and I'm making 2% off this loan that I loaned it to Emma, and all of a sudden other people are making loans for 4% because the interest rates have gone up, the value of my loan goes down. So if I'm going to sell it to somebody or whatnot, I'm losing money because of the opportunity cost. That's what happened. And the reason why they didn't expect this to happen is because they thought that somehow you could go lower than 0% on loans, essentially. I mean,
yeah, more or less. I mean, I think that the sort of view, I guess, in the financial sector in general has been that the Fed can't keep rates high for a long period of time, but that's because we hadn't seen inflation in years and years. And so, but the thing is, like, also normally a bank will hedge, right? Like they'll do these sort of complicated things and they'll say, okay, it's because we have this trade on, when interest rates go up, we won't lose an absolute ton of money. But the thing is that like that's something that every bank is dealing with, basically. Most banks have these like big portfolios of treasuries, which is, again, is totally fine. Like it's something that is a high quality liquid asset. It's not like the mortgage crisis because the treasury is going to pay back that debt. Like it's not like it's a bad loan necessarily or a bad bond, but
it's not worth zero, which in many cases some of these tranches were during the financial crisis. But it's just not, they're just not making hand over fist. And this is also a culture where a lot of these people are expecting, a lot of the VCs out there are looking for 100x return. So if they're only getting like 10x or 5x, then they convince themselves that they're losing money and everybody freaks out.
And I'm trying to think about like the run aspect of this too. So like you have these losses on the balance sheet. It doesn't really matter until you have to sell the bonds. Right? Because you're going to get your principal back. There's not going to be a default. And like, it's, if you mark them all to market, like that's not great. And obviously it's kind of ridiculous that like, they're just not marking things to market in general. But then you don't have to liquidate them unless everyone pulls their money out at the same time. The problem is that we have a bunch of venture capitalists who are like all in the same group chat saying like, oh my God, I think our bank might not be safe. And then everyone yanks out their money. And then all of a sudden you can't fulfill those demands for money without selling those bonds at a loss.
I see.
So like they basically could have avoided that disaster entirely by not starting a run on their own bank.
And to what extent was there also pressure on a bank like this in particular? Because you have a lot of businesses that are, essentially their cash flow is bad because they're really just trying to create a valuation so they get bought by somebody else. So they've been taking a lot of loans to pay their operating expenses. That's been their sort of like business plan. And then all of a sudden the loans start getting prohibitively expensive and they got to start. I mean, I think we've seen a lot of layoffs in the tech industry because of this. How much did that also contributed, or just did it create an environment around where everybody was ready to freak out?
I think it definitely created an environment where everyone was ready to freak out. I also think that usually when a bank has a run or like you end up in trouble like that, regulators move in, but the thing they want to do most is sell the bank. They want to find a buyer. But the thing is that if you have a ton of money losing companies, and you're like, oh, that's our loan book. How good. People, it's a lot less attractive, basically, if you have just this one group of people who are now under a lot of financial pressure. So I think that like the conditions were kind of already set up for a run. And then when the run happened, people were like, oh, why would I want to own like, I don't
All
know,
these like
Juicero loans? Right?
mythic companies
Yeah.
that aren't necessarily profitable yet. They're
Yeah.
all just banking on future profitability. So
Yes.
so let's move into like how much did the Fed's actual exercise of regulation allow this to also metastasize?
Yeah, that's a really good question too, because again, I do think that, you know, it's very clear that management of that bank was very aware of the limits that they had to stay under to get regulated more intensely. And when those limits went up, the size of the bank went up. And I think that, you know, again, if regulators are sort of in there all the time, like they can make sure that you're not taking your deposits and then tying them up completely unhedged in things that will like experience pretty severe losses, right? And like some of the you know, the regulation aspect is really interesting, because again, like what I've heard about bank regulation, like once you reach a certain point, is that it's just a much more hands-on process. Like regulators are in the office more, they're looking much closer at your books, and you know, the amount of effort that financial institutions put in to avoid like breaching those kind of thresholds or getting included in certain groups, like if you're like a globally systemically important bank, you know, you have a completely different set of regulations, and most financial institutions that aren't them avoid that at all costs and will like really freak out if anyone even breathes the idea that like, oh, could you be systemically important?
Right. All right. So is there any, I mean, from your perspective or from like, just like in general, is there any like perspective now that like we shouldn't go back to at least, I mean, I mean, we got to re-lower the threshold, right? I mean, I don't know if a guy has to go to 50 billion or to 75 billion or to 35 billion or what, but this threshold is too high if it created this type of freak out because these laws were intended to avoid this very thing.
Yeah, and again, this was the 16th biggest bank in the United States.
Right.
That was not subject to liquidity regulations. It was not, I mean, so like it's hard to talk about bank regulation a lot of the time because things are like a liquidity coverage ratio and a supplementary leverage rate, and it basically everyone falls asleep as soon as you start talking about it. But there are like these extra sort of liquidity requirements and high quality asset holding requirements that I think do get applied in, I don't want to say inconsistent ways because everyone knows like the big banks, right? Like the biggest banks, like the JP Morgans, Bank of America's, whatever, they're all subject to these regulations. And the regional banks push really hard to avoid them.
Right. But the liquidity requirements would really hurt their business model, right? Because for Silicon Valley Bank in particular, if they're working with these companies that are cash poor, I mean, there's not. This is probably more endemic to Silicon Valley right now than we might want to admit.
Yeah, I think that the sort of tech deflation, the startup deflation, really has, let me try to think of the best way to put this again, because, you know, you start talking about like really abstract financial stuff. I mean, a lot of that has to do with interest rates going up also, because when you can start earning a return in cash, then all of a sudden, why do you need to put your money in this highly speculative venture that like maybe will make a ton of money, like selling juice packs or whatever, right? Like Juicera is always the one I think of because I've been doing this for a little while now. But like the general demand, I think, for those kinds of investments is just going down. So like, why would you give your money to a company that's burning a ton of money even if it just like does the most ridiculous stuff on earth, because you can actually earn a return in a money market fund. So like deposits are draining out from these smaller banks, kind of broadly actually, but it's just hitting Silicon Valley hardest because A, like they move their money really fast. B, the insurance that you have to get, I guess, on those bank accounts, or that you have to get. Basically, there's so much money concentrated in so few hands in Silicon Valley, or like it's all corporations and stuff. So you do end up having like really big like checking accounts, basically.
But isn't there also, so now we're moving into that FDIC threshold, and this is the last sort of like a tranche that we will talk about, if you will. Aren't there things called like sweeps? You mentioned that, are third-party companies that come in and say, you've got a problem, you've got so much money that you want access to it quickly and easily, but you can't put it all in one bank because then it'll be above the FDIC threshold. My understanding, and we just played a clip from, what was it, Aaron Ross Sorkin? Is that guy's name? From CNBC. Basically raising the fact that people were getting, and I've heard stories of this. I know some people sort of second or third hand who have access to like 0% mortgages because they have $500,000 or $1 million in a bank account. And they're basically saying, I'm willing to risk $750,000 of that if I have $1 million in there because I'm getting a free loan from this bank because they want all this cash. Isn't that what was going on there? And in some instances, the implication was that they're putting their business money in there and getting these personal sort of like it's kickback, right? I mean, that's a kickback. I mean, so A, is it your sense that these things should be illegal? Or if they're not illegal, then shouldn't they have to assume the risk? Like, I mean, how do you have it on both ends? If it's not illegal, then why don't you get to assume the risk in this instance?
Right. And that's one of the confusing things about it, because again, a lot of the deposits were like, it's not like, I saw all this stuff on Twitter, God help me, about, oh, well, if it was a farmer's bank, then like no one would be upset that the depositors were made whole. And that just the use of the funding and the sort of concentration of the funding, I think you just don't see in other areas. And again, I think I've also heard that Silicon Valley Bank was pretty aggressive in consolidating, I guess, and like keeping its clients close. So they wanted to be the one-stop shop for everything. So if you want to be the one-stop shop for personal banking, business banking, whoever, just for one group of people, and then you end up being the 20th, less than the 16th biggest bank in the country, like it's just kind of wild to me that no one was like, oh, maybe there's some risk here.
Well, like, they knew that there was risk there. They were just getting benefit. They were just making an assessment, an incorrect one in the final analysis, that the benefit was worth it. I don't know how many, I used to keep tally of how many FDIC bank takeovers that we had in any given year because I was doing this during the last crisis. I don't know. I imagine it's a couple these days. Maybe anywhere can be, I remember when it was like 24, 50, there's a lot.
Yeah.
How many like farmer banks, how many banks do we generally see where there is 90% of the holdings in that bank are above the FDIC threshold? Because I don't think that happens. I mean, if there was farmers making that much money, and they were larding up a bank like that, I don't think I would have any more or less sympathy than I do for anybody else. It's like, but farmers are supposedly, but even farmers, it seems to me, they're much better with their money than these people.
Yeah, it was crazy. I mean, I think it was like 93% or something of the deposits were over the FDIC insurance limit. And, again, like that's $250K. people are saying like, oh, well, companies can't make payroll. But then again, at the same
sweeps,
time, exactly.
That exists.
Treasury management.
They must know that. If I know
business.
that after a day of this happening, I would imagine they must know this.
There's an entire business around it, you know, and actually I was listening to some VCs talk about it, I think on a podcast or something, but they were saying like, oh yeah, like I was taught when I was coming up to move my money around. It's like, well, okay, why didn't you do that?
Well, because they're getting sweetheart deals. We're thinking.
Yeah.
Yeah, I mean that's got to come out in the next week or so, right?
Yeah. I mean, again, there was and is a lot of talk about how intensely or how sort of aggressively Silicon Valley Bank. Everyone says like, oh, they courted their customers, but they really were like, okay. One example is I think Coinbase had to sell warrants to them in order to like get a banking account because crypto. You can also, there are good questions about whether crypto firms should be able to access the U.S. banking system. But they were saying, okay, we'll give you access to our payments system, but we need a cut. So like, as you were talking about this sort of like kickback thing, like they were saying, okay, we will actually let you use the payment system, but we need a chunk of your equity. So I think it's going to be really interesting to see what comes out there.
Well, Alexandra Scaggs, reporter for the Financial Times. I know you've probably got about 14 other things to do right now during your Christmas time. Thanks so much. Exactly. Well, good luck with it. I hope things calm down for you. Really appreciate your helping us out with this.
Thanks so much again for having me.